I have been in this business news game a very, very, very long time. I've seen great investors come and go, charlatans, harlatans, ballers, shot callers, fakers, makers, everything. But I've never seen anyone rise to the level that our next guest has in terms of the organic influence, the clarity of his message, the sense of purpose, and his willingness to share with others. Those are traits that we really love around here. They call him the master investor, and he's got that track record to prove it. But his wisdom and his influence are about far more than his trading account balances. Yes, he does well. He makes some smart trades. He's done very well for himself. But it's really about his generosity towards others, his desire to keep learning as an investor, and the humble way he goes about his business that make him the master investor. You may know him from his Red Panda Academy or from Market Mondays on Earn Your Leisure or through his social media platforms. He's got hundreds and hundreds of thousands of followers. But ladies and gentlemen, please welcome Ian Dunlap to Studio Sessions on the screen.
My brother, thank you so much. How are you?
Ian, I'm great. So good to see you. And thank you for taking the time to do this. You are a busy person, but it's so good to have you join this program. And I've watched you a lot. And you're constantly talking about the fundamentals. You're constantly talking about what's happening within industries and within sectors. So did some of that translate over into your investing skills?
Yes, I think it was one of the greatest skill sets that allowed me to understand how to invest, because if I knew how to break down a SWOT analysis, and if I knew how to go through the fundamentals and the KPIs, it gave me an insight on what I should invest in. Also, knowing which companies were spending on advertising to grow their brand to get market share allowed me to still go through Ad Age to this day to see what's happening in media, what's happening in space. So for those of you that are in creative spaces, that are in advertising, that's going to give you a huge edge. Art used to tell me all the, if you're good in one business, it's easy for you to be good in another. You'll just get paid a lot more when you cross over to investing. And he was absolutely right.
You created a lot through your platforms. You have a huge following. Tell us about the Red Panda Academy. What was the inspiration there? What are you trying to do there?
Red Panda, kudos to everybody in Red Panda who's attending. I love you guys so much and thank you. Red Panda is my family, my tribe. So when I first got into investing, I wanted a simple answer. So I didn't have access to you back then, right? So I wish I could have just called someone and said, hey, what do you think of Apple? Or back in the day, Research in Motion or IBM. There was no person I can go to get a simple answer if it was a buy, a sell, and where to get in. So for Red Panda, my entire drive is to make investing easy, that everyone in our community never has to think about how to invest, which company is good, which one is bad, which one to stay away from. So I think the brother just said, like put your crab leg money into Bitcoin. So like when I call Bitcoin at 20,000, I want to make an easy platform for people to know how to invest without fear, because I think the biggest thing that draws people away from investing is not knowing when something is going to be profitable and when do we get in? When's the best time to get in? So that's what I try to create in our community.
Yeah, and you're constantly having those conversations, and I know you're getting thousands of questions a day. Just watching you on Market Mondays, the questions are just spilling through the chat about what to do, which one. Yeah, and you take a lot along with Troy and Rashad, so you're really doing a lot of folks a great service there. Let's talk about your process, though. Fundamentals versus technicals. I know you're deep into the industries, deep into the sectors. What is it that speaks to you more? Are you looking at that plumbing of the company, the health check of the company, or are you looking at price, or are you looking at a hybrid?
I'm looking at the hybrid. So number one is always the global macroeconomic environment. So like what's happening with quantitative easing? That's always number one for me. Number two, what are the current interest rates and where we in terms of inflation, right? So in 2018, 2017, 2016, every company looked amazing. Interest rates were almost at zero. So it's easy for any company at that point to be profitable. Now interest rates are a little bit higher. I'm even hearing on the mortgage side, like mortgages may go to 11% next year. Won't be good for certain sectors as a result. Then I will go to fundamentals. Who has biggest market share? Who has biggest mind share? It's not talked about enough, but like heart share. Emotionally, when I bring up a brand, do you love it or hate it? So if I bring up Apple, there's some people that will love it. If I bring up this week Kanye West, may not be a lot of people that love that brand. So I factor that in. Then I'll go through top line revenue, profit margins, estimations of where they'll be over the next 2 or 3 years, and then I'll go to technicals. I know some people love technicals first, but for me, the technical analysis is just the fundamentals printed on the screen. And I think it's a huge mistake not to factor in all three. Like, you could have had great technicals in 2021. Quantitative easing destroyed every level that we had planned out prior to those numbers being printed recently.
Yeah. So when we're talking about quantitative easing, for folks that haven't heard that term before, that's the Federal Reserve now actually selling government bonds out into the market, selling mortgage-backed bonds out into the market. And for years, really since the great financial crisis, mostly, they've been buying them. They've been the buyer of last resort. We talk a lot about the stock market around here, but folks, the bond market really runs things. So when Ian says quantitative tightening, Fed's selling bonds, that's a very different story. And raising interest rates to combat inflation, very different from where we've been over the last 10 to 12 years, where basically money was very cheap. So as you look at that dynamic, Ian, people I know are asking you this question all the time. You could have really just thrown darts in 2020, 2021. Now it's very different. Now we really got to be smart about company selection, sector selection, right? I heard you on Monday night talking about it too. It's like the game has changed. So how do you make changes within your portfolio when the game changes like this?
In every sector, I have to look at the top 10 sectors globally. I'm now looking a lot more at the companies that are in India that could have a tremendous impact over the next 3 or 4 years. For those you don't know, there are a lot of American companies that are now building factories in India as a hedge. Things are, of course, slowing down and slowly falling apart with China. So you have to look internationally first to see where can an American company have an edge space. That's first and foremost. Secondly, I have to go to the companies that are actually able to drive revenue. So you have to be nimble. It was easy to invest in any company that was in the technology sector as long as there was top 50. Now I won't leave the top 5. So Apple, Microsoft, Google are the 3 that I like the most. There are no dark horses right now that I truly love. And now I'm looking at commodities more. I trade futures, so I've always been looking at the S&P 500, Dow, NASDAQ, the bond market, but now I'm looking at wheat, crude, palladium, gold to give me some more gains that are being lost in holding long term. And even for me, and some of the stocks that I'm holding long term, I'm down on. I'm dollar cost averaging like crazy. I know it's a phrase that we both love, but it's not fun to dollar cost average and you're down 18% and you don't know when we're going to come out of a recession. Next year, we're going to have inflation until probably November. So next year, we're going to range really hard in 2023. And whenever they finally announce the recession, I think we'll start to get a bounce because we'll have a lot more institutional buying on that side. But next year is going to be rough. But if you're holding for the long term, it's going to be one of the greatest opportunities that we've seen since 2008.
And you have a time horizon. You're a young person still. A lot of the folks out here are very young. I'm in my 50s. I'm still investing. I'm dollar cost averaging because I got 20, 25 years at least of investing in front of me. And I think it's an opportunity, but you never know. You could be wrong. That said, that takes a lot of discipline, Ian. Just being able to say, I know I'm down, but I still believe, so I'm going to put a little bit in every month. What does that do, though? That gets that magic fairy dust of the stock market, that compounding, which is, I think, one of the 8 or 9 wonders of the world. That gets that working for you when things finally do turn around. How important is that? When did you learn about that, and how have you applied it?
I learned about it in 2009 after I had missed the move in 2008. Some may know the story, but my buddy Art was working as a trader at JP Morgan when the crash was happening. He told me what to invest in. He caught Citi at 97 cents and $1.03. Told me to buy it. I didn't buy it. And from 2008, I think Art is maybe 46 now. He's still retired from the investments that he made in 2008. So when I missed out, I said, I'm never going to miss out again. And I asked him, how did you continue to invest when the market was down? But he was like, if I know that the average price of Citi should be $16 and I caught it at less than $1, my multiple should at least be 14, 15 when I liquidate. Worst case 8 if I'm nervous, because when you get up 800%, it's hard not to take profit. So if we go through like a half a decade that's flat, think of the amazing buying opportunity. For me, I missed on 2008, but everything that I know now, I get a chance to take advantage of as if it was 2008 all over again. So if we're down the next year or 2 years, I know if I hold, on average, I should be up 11x by the time 2027 comes around. And that is very exciting for me and my family and my son and everybody in Red Panda, everyone tuning in here today.
I'm excited for you just hearing that. I'd like you to be up 11x as well. But
let's do it.
This is not an accident. This is a discipline. This is a practice. This is a belief in a plan, having the plan, and then having the conviction to follow through with that plan. Very hard to do, Ian, when day after day we're seeing red numbers out there, right? We're in a bear market right now. We don't know when it's going to end. We have all these headwinds coming at us. How hard is it to stick to that plan, but how important is it on the flip side?
It's one of the hardest things to do financially because it feels like everyone who's listening, doesn't it feel like you're wasting your money when you're buying in the down market and it continues to press down? You're like, man, I thought we would have had support at 105 and now we're at 83 bucks. And I'll say it's easier some days just not to open your account. But when you look at it historically, and I think who we mentor financially is very key. So Buffett, of course, has played a huge impact on my career, but so is Templeton. So like when Templeton was during the Depression, he made a lot of money by holding for an 8 or 10 year period. And I'm looking to replicate that strategy now. I have to admit, it's hard as hell to hold while the market is falling apart. But the upside is if we get this right and we buy into the right sectors, 5 or 6 years from now, we will have the opportunity to never have to work again and pass a lot of that wealth on to our family and friends. And the thing that I tell everyone is your friends or family may not listen to me, but if they see you take 10,000 and you put into the market this year and next year, and in 5 years you walk away with 200,000, trust me, all of your friends will listen to you. So it's not just about me and us doing it. Think of all the thousands of other people that we can impact with our action by investing in a down market.
Yeah. As Dex was saying earlier, generational wealth too. That's what we're all ultimately trying to build here. Look, I know you consume a lot of financial media because you reference it a lot of the time, but you look at a bunch of different sources as well.
Yeah.
But financial media, and guilty as charged, sometimes we're out there treating it like a game, treating it like it's a sporting event. Diane and I were talking about that earlier. But you consume that with a bunch of other sources. So what's the process for your research, and how do you tune in, tune out the things that make more sense to you, because it's coming at us all day long?
Yeah, for me, my list is I try actively read 50 pages a day. Some days are better than others, but I'll go through Bloomberg, CNBC, Barron's, Reuters, Investopedia, Wall Street Journal. Then I'll go through Instagram. Like, so there's people I follow, Wall Street Trapper, Earn Your Leisure, Josh Brown. I'm consuming all of their content, and I'll text people. Bonawyn, there's a few people I'll text and see, hey, what do you think about the market today? Where do you think that we can go? And then after that, it's really just filtering out what makes sense based on the analysis that I've done. And most importantly, I'm searching for the information that tells me I can be wrong. So I had a conversation today, and someone asked me, how much longer do I think Apple will be in a dominant space? I said, maybe 2034 in best case scenario. But if Tim Cook walks away tomorrow morning, my position on Apple is going to change dramatically because I haven't heard of a strong succession plan. So I'm not always looking for the information that backs my thesis. I'm looking for the information that begins to tell me that I'm wrong about the position. That way I'm not caught off guard. So when everything was going well and quantitative easing, which lifted the market from 2008 to 21, once that tapered, every thought that I had on the market then changed. I had to go to my worst case scenario planning. And I think as an investor, we always have to factor in, what are we going to do in the worst case scenario? If Tim Cook leaves, I have to change my position on Apple. Like when I trade futures, my biggest nightmare is if NinjaTrader doesn't allow me to trade contracts on the futures market at $500 per share or contract. What do? But I have to have a plan in place for when those disaster level events do happen. So I hope that helps.
Yeah. We like to say strong beliefs, loosely held. Be ready to change your mind if the facts change. And the facts are always changing. This is a market and a marketplace and a really tricky time in the global economy right now. So you've got, as I said, hundreds of thousands of followers. You're on the Market Mondays with Troy and Rashad, a terrific show. If you're not watching that, you're missing great content. But you also have your stuff going through your academy. You're in a lot of different places, but you've been able to build a business around the influence that you do have through the education that you share. What are you doing with that ultimately? What's the end game for what you're doing besides doing quite well for yourself? But what do you want to do with this?
My ultimate goal is to be able, to be very honest, I didn't know how to break into the hedge fund ecosystem. So when because I had pretty great returns, and once I started reaching out to people about potentially being a client, they're like, "Hey, I didn't know of you. I don't know enough about you. You don't have a long enough track record yet." So everything that I did media-wise was to build credibility. So ultimately, my goal is I want to take those that are in Red Panda, have great success, and start to put them into Citadel and GTS and Trade Moss and JP Morgan, and build a bridge from the retail side to the institutional side. I think when we had that moment last year, when it was AMC and GameStop versus the world, it wasn't that they believed in GameStop and AMC so much. It was more so of, I don't know how to get it to the institution, but I do love trading. I do love investing. And I'm sure you can remember in 2012, 2013, there was like almost an open outcry for how do we get retail investors into the market. And then we came, and it was almost felt as if we were not wanted. So my ultimate goal now is to build a bridge from the retail side to the institutional side to allow and facilitate jobs to be created, because I truly believe there's some incredibly talented people on the retail side that could operate on an institutional level. They just didn't know how to break in, and I was one of them that did not know how.
Yeah, that's a great mission, and that's a sorely needed mission, because it seems like a gated community in a lot of ways, and there's a reason for that. But I want to get back to something you're saying. The last couple of years really changed the game, changed the framing, when so many individual investors join the market either to trade, chase a meme stock, chase a cryptocurrency. But then, as Warren Buffett likes to say, one of my people I admire as well, you find out who's swimming naked when the tide goes out, right?
Absolutely, yeah.
So then a lot of people don't want anything to do with it anymore, which, again, we were talking about this earlier. The stock market's the only place where people run the other way when things go on sale. We're in a really tough time right now, and everyone's running out, and so many accounts have closed or are inactive. What's your message to folks that got in it and got scared by that volatility, got scared by the losses, but now they're looking at a stock market down 24%?
When you have your biggest losses, that's when God is going to talk to you about how to win the most. So anyone who's ever traded, please raise your hand if you're in the audience. You ever taken a loss and it feels like God is like downloading all the information that you should have done before the loss? So when I had my biggest trades that I've lost and I've cried, I'm like, okay, let me write down. So all the lessons that I share come from what happens when I lost. So when I used to trade off of emotion, or even when I was buying, let's say, Research in Motion long-term, because I made money from it short end originally. And I'm like, hey, it has to go back up. And then some guy named Steve Jobs come out with this thing called the iPhone in 2007 and just wrecked the company. And I'm like, there's no way it can go down to like $12. And I'm holding this thing from 40. And it taught me, no matter what your opinion or emotion is, you cannot fight the data. So that's when I started to put my rule set together. For those of you that are down big now, invest more into learning. If you have time to go through all the information on Investopedia, and you guys know I only like recommend and endorse people that I truly love and things that I use. I was a fan of Investopedia before I had the honor of meeting Caleb. Go through all the information there. Map out a plan, and when you don't deviate from your plan, it's going to give you wins like nothing else on earth will. So it's the pain that is actually going to give you the blueprint to be able to win into the market. It's not the wins, because anytime we win long term or with trading, we don't really remember the lessons that caused us to win. We just celebrate the victory in the money. When we're down 30% or 40%, we'll read every book possible and take every note possible to get better. So use that as your fuel to do better.
Yeah, when we win, we think we're geniuses and we can outsmart the market, and we belong at the table with Warren Buffett and Charlie Munger and some of the greatest investors in the world. The truth is, what do they do all day long? They read.
Yes.
What do they do all day long? They talk to smart people. What do they do all day long? They study companies very similar to what you're doing, what a lot of the folks are doing. You talked about some of your mistakes, but are there individual companies or plays where you just said, I just missed that completely? How do I pick myself up from this and keep going?
Even on the angel investing side, I told a story before, but in 2006, I had a chance to get in on the family and friends round on Facebook. Could not convince my family to do so. It taught me two key lessons: A, to have the capital ready when it was needed, and number two, learn how to sell better. Because the truth is, the 150 probably could have been raised if I pitched better. That $150,000 investment amongst my family would have turned into $33 million. So every day that my family's on Facebook, to this day, they're like, hey, we should have listened, but also I should have pitched better. I got an AMD at a great price. I wish I could have had a chance to get an AMD at $4. Missed that long term. I missed shorting ARKK, one of Kathy Wood's funds last year when I knew it was going to fall apart before most of the world did. I'll tell every investor, you lose every day. Like if you have a good investment, you didn't put enough money into it. And every time we have a losing trade, we put too much money into it. So no matter how many wins we amass over time, we've always could have done more. I'm trying to think of another one that I missed out on.
Oh, that's plenty painful, Ian. Don't torture yourself. But those are some big ones. Yeah. I got my own list. I was the one who bought Lehman Brothers when it went from 80 to 20, thinking this 110-year-old bank's not going anywhere.
But think about that, and going off the data, they could have saved Lehman, and technically, Lehman should not have went out of business. That was a safe bet. But then you have the inner workings behind the scenes, and you know there's some powers that be that said, "Hey, maybe we should let this one fall." It should. I mean, that entire year felt like an episode of Billions. Lehman should have been saved, and in the real world, Lehman would have went from $20 and probably would have been at $300 4 or 5 years later, but it didn't make it. It just didn't.
They chose to let it fail. Yes. Agreed, but I chose to think I could outsmart everybody, and I lost a fair amount of money at a pretty young age. But I won't do that again, and I won't make those kinds of mistakes again. I'm a little bit more boring. But you have a process. We talked about this combination you use of, what's going on in the economy, macro, yes, company-specific stuff, sector-specific stuff, and also price, technical analysis. Great combination of ingredients to really build smart portfolios. And you trade options, and you're trading commodities. You got a bunch of different systems. For folks out here getting started, Ian, what's the best sort of course of action, the simple steps to become a market participant? What do you recommend? And you don't need to recommend a specific product per se, but just the steps and the process.
Well, first I want to say I trade futures, not options, because I don't want the option traders to be like, Ian doesn't know what he's talking about. Right?
Futures, not options.
Yeah. But for me, first start with long term, because for all my traders, and I used to think the same thing, and I would be in chat rooms and people will say, well, if I can get 300% return trading, why would I hold long term? At some point, there's decay in the strategy. So you'll go from making 300%, and then sometimes, unfortunately, we'll go negative 200 or negative 400%. So you have to invest in the market for long term to be able to create wealth. Also, it does give you an advantage long term. I tell every trader, if you want to know what the direction of the market is, all you have to do is open your portfolio. Now, it's really easy. If you're opening your account every day and it's bloody red as soon as you open it, you should be shorting the S&P 500 or NASDAQ or Dow. As far as getting started on the trading side, I know you're a big fan of this. I would simulate minimum 100 trades. Get your feet wet, practice. For those of you who start off doing very well, don't go to live trading and using your real money yet, because that hot streak can easily turn into a cold streak. Has anyone, and you can raise your hand or put yes in the comments, any of you like won 10 trades or 5 trades in a row on paper, then you went live and you lost like 15 in a row, then all of a sudden you burned through all of your money? Practice there first, and then pick one asset class that you want to participate in. So whether it's penny stocks, options, futures, pick that one. And then most importantly, when you're trading, pick one target. I see too many traders, they have a scalp target, a swing target, a long-term target, a parabolic target, a breakout target, a down. I'm like, you can't build a plan off of 8 or 9 different setups. Stick to one, and it will impact your career incredibly well to the upside.
Now, who has the time to handle all those different trades at once? So that's the other thing too. If you're going to do this as a hobby, keep it simple, right? If you're going to do this and sit down and do it all day long, then you could get a little bit more advanced and try a bunch of different platforms and different asset classes, but it can get very, very confusing out there. So, what about cryptocurrency, Ian? Is this something that you've experimented with? Is this something you believe in? We had a good conversation with Lamar and Gigi a few minutes ago. What's your take on it, and in terms of an investment, and both in terms of a utilitarian technology that we may use in the future?
Crypto, I'm a fan of a few. So like Bitcoin, Ethereum, Cardano, Ripple are the 4 that I like the most. Once again, you have to hold them for the long term. Last year, I got a little bit of criticism for saying that the banking institutions would overtake crypto and have a lot of influence there. We've now seen that's panned out to be true. So as with any asset class, you have to hold it for the long term to get the best use out of it. And then also too, like if you're a fan of a currency, just make sure to do your research. I would define research as at least 200 to 300 hours on that particular asset class. So you know about the founder, what the utility is, what are the pros of it, what are the cons, and also to look at what institutions are going to back it or buy it as a part of their portfolio, so you have enough volume in order for it to swing to the upside. I like a lot of the premises of most cryptocurrencies, but I do want you guys to be careful about the ones that are a little bit more on the darker edge. But yeah, cryptocurrency is here to stay. Anyone who says that it is not, I think that's a huge mistake. And I also think it shows at scale that people want higher returns than a typical 7 to 12% that has been promised. Now, if institutions are able to do that, we'll find out over the next 3 or 4 years. But I think the initial allure of Bitcoin was the growth that it was able to provide month over month and year over year. I mean, some may know this, but I got caught up in the Mt. Gox scandal. I had it 2012, 2013. So make sure that the platforms with are solvent. First and foremost, make sure that the founders are credible and have a track record of doing good business, because you don't want your cryptocurrency to go away how mine did in 2013.
Best thing you can recommend for young folks just getting into, or folks of any age, including people like me, to get into the game, something you may have read, something you may have seen that really sparked your interest, that really opened your eyes into the possibilities of being a master investor?
I know people are tired of me saying this, but Money Master the Game by Tony Robbins is a investing book that changed my life. And for those who are not a fan of Tony, it's not Tony's opinion. He just interviewed the best people in the world. It's also what sparked Ray Dalio to write his book. So those 2 books. So those 3 books in combination are great. Prior to the book being written, there wasn't many books that took the perspective of many traders. And of course, you had Market Wizards, which if you read Money Master the Game, that is like the investing version of Market Wizards. But it gave a clear emphasis on why indexing was important. And what I took from that was to invest in indexes long term. I added the technology component to it. But if you want one book that is going to give you an amazing perspective on why you need to invest for the long term, Money Master the Game is that book. And I've told people for years, like, if you read the book from cover to cover and you don't like it, I will pay you back the money for the book. And I have no affiliation with Tony or anybody who's in the book. But that book changed my life for the better. Of course, Investopedia.com and anything that Ray Dalio has written or Kyle Bass has written and Paul Tudor Jones, inspiration of mine. Those are the people that I go to and read their information first.
Which was my next question, which was, who has been your greatest influence as an investor? You've named some big names here, but was there somebody outside of the pantheon of, some of the world's most famous investors that really tipped you off? Because you are that person now for so many other people. Who was it that you knew in your life when you said, I want to do what they're doing, or I want to learn what they're learning?
Honestly, my mom, dad, and grandma. It's interesting how so my dad is in real estate and construction, and I go back now and I tell my dad every week, man, I should have listened to you when I was 10 years old. So for those of you who are underinvested in the stock market, I'm underinvested in real estate. Because I'm thinking, why would I want one unit at a time that pays me $800 a month or $1,000 per month? I was a silly 10-year-old. Dad, please forgive me if you're watching this live. But a lot of the principles I learned from investing on, you want to put in $1 and make $4 or $1 and make $5. I learned there. From my grandmother, it was no debt. I don't want you to have any debt because debt is a blanket that I never want you to lay up under unless you choose to. And I'm like, why? And she was like, when you have a bunch of debt, you lay down at night, the stress that it brings you. And this is the part that most people never talk about, whether it's commercial debt or personal. When we lay down at night, and those, especially in a time like now during a recession, I know some people that have almost had heart attacks over the amount of money that they owe to a lender. So just the principles I learned from my mom, dad, grandma early on, they were my initial inspiration. And then after that, it was Buffett, Peter Lynch, Paul Tudor Jones, Kyle Bass, even Jamie Dimon, like some of the things he's been able to do. Some of the traders that started off at Goldman and turned Goldman into what it is now. Those stories are incredibly fascinating. Carl Icahn, he has a great documentary on Showtime that you guys should go watch. Yeah, those all have been inspirations as well after my mom, dad, and grandma.
I like mom, dad, and grandma too. Those are great choices. Let's go out on this, Ian. You know, we're a site built on our financial terms, our dictionary. Do you have a favorite investing term or word that just speaks to your heart, that just makes you smile?
My favorite term, that's a great question. I've never been asked that. Risk to reward ratio. That changed my life forever. For every dollar that you're going to put in, what is the return that you're expecting to receive if I deploy that? And I've taken that to apply that to return on happiness, return on friendship, return on personal relationships. So even for me, if I'm not well rested, I can be a little bit grumpy. I try to make sure that my risk to reward ratio is relatively high. And also even in the content I get, if you have 80 options to listen to, when I put out a piece of information, I at least want it to be like in the top 5 best pieces of information that you've ever received in life. So risk, because as a trader, before I $1 to make $1. Anyone who's ever traded, when you're on a hot streak, it works incredibly well. But when you start losing, you run out of money really fast. And then I adjusted to risking $1 to make 5 or 100 to make 500. And now I'm at a place where I'm risking $1 to make 11 or $1 to make 50. So you want to put those odds in your favor. And here's a great thing. If you're risking, quick exercise for everyone. If you're risking $1 and your return will be 48, what percentage is that? And I'll give a prize. Who said it?
What's the answer? Give us the equation one more time, Ian.
1 divided by 48. What percentage of the time do you have to be right?
2 to 3%.
Yes. Can we get his information so I can cash up him $500 for participating, please? Yeah, now people want to participate, but think of it like this. Now you only have to be right in 2 to 3% of the bets that you take in order to make a lot of money. So the higher the reward and the lower the risk, the better things will go in our favor. And if we look at a lot of companies right now, a lot of companies prior to 2020 did not have a good risk to reward ratio or having a high probability of having success in the market. Peloton, there's a few other I can name, but I don't want to.
Now, we love that. We love that term. One of our favorites, one of the most popular ones here at Investopedia. And Ian, I can't say enough about how generous you are with your knowledge, with not just giving other people starts, but also sharing the knowledge, sharing what you've learned, the good and the bad. And you have a huge platform in which you do it. So I'm grateful to you. Thank you,
Caleb,
for joining Studio.
We have a few questions online.
We do have a few questions online.
Thank you.
We
have one in the audience. She'll start. Hi, Ian, Caleb.
Hi.
Hi, how are you?
Kristen Myers, editor-in-chief of The Balance.
Welcome.
Hey, Queen, how are you?
Long-time listener, first-time caller. Um, so obviously we're headed into a recession in 2023, as most people are saying. What I want to know, since a lot of people have made predictions of what we should be investing in for the second half of the year, but we're already at the end of this year. What are you looking at? What do you think we should be adding to our portfolios for the first half of the year in 2023, given these recessionary times? I'm asking for a friend. I'm the friend.
I appreciate you. I think whatever we invest in for next year, it shouldn't change based on a 6-month cycle. I'm looking for, if you're looking in the tech sector, I'm waiting till everything's like 92% off the highs. And I know it sounds improbable, but if inflation continues to ramp up the way that I believe it will in 23, a lot of companies will get there. And I'm also looking at a lot of commodities, but a company that I do like, General Dynamics is one of them, and General Mills, which is more famously known for
weapons and Wheaties.
Yes,
basically.
Yes, but and also too in times of war, and it used to be Halliburton, but I think General Dynamics is going to take that space. People are going to have to invest in that sector because it's going to be viable, especially if we don't get control of this Ukraine and Russia situation, as well as China, and people are going to need to eat. And prior to COVID in 2020, General Mills was doing incredibly well. Margins are pretty solid, very great leadership team. So yeah, General Dynamics and General Mills are two that I love going on.
Great. Question from online, Ian. Jess is going to read it.
This is from Dr. Grant. How can others assist in building the collective vision for a wealth fortress? That's a big question.
That's a great question. Can we read it one more time?
How can others assist in building the collective vision for a wealth fortress?
I think it's things like we're doing tonight, is getting together, and I think we should do something like this weekly, where we just come together, everyone shares an idea, and we compound upon that idea. Because imagine if in 2008 we would have had this platform, it would have taken a lot of the fear out of 2020. But I think we need more town halls like this where we're able to dialogue with one another and then build upon that. So it may not be the sexy answer that is wanted, but that's how Market Mondays operates. I think something like this weekly would be absolutely amazing.
Market Mondays is a great place for that because you're getting thousands and thousands of people exchanging ideas and asking questions.
Thank you.
Another question? What's that?
When are you going to be back on Market Mondays? I'm going to put
anytime. I'll see you out in London first, but we'll definitely do that again. Go ahead.
This is from Aaron online. With our current economic environment, what would your investing approach suggestion be for someone who may not have a lot of experience in picking? Do you go all in on stocks, all in on an index, or do you mix?
If you have a little money and it's money that you absolutely do not want to lose or you're fearful, I would go heavy on indexes. So the S&P 500, like literally if you hold for 20 years, and I know you may not be thinking 20 years from now, but if you want a safe bet 20 years from now, the S&P and Dow are still going to be around. The companies that underperform will be kicked out and new players will take their place. If you have a little bit more risk tolerance, I would mix some in. I will wait to tech draws down even more, or I would do, as Caleb said, Wheaties and war for sure. And General Dynamics outside of 2023, 2022 is going to be a good investment. So I try to only recommend companies that are going to do great over a 10-year period anyhow. But General Mills and General Dynamic are both two amazing companies. And as long as Tim Cook is there, I'm a huge believer in Apple.
Good question. Great. We good? Terrific. Ian Dunlap, the master investor. I'm so glad we became friends. I'm so glad you were able to spend some time with us today. Thank you so much for joining us. Folks, follow him. Check out Market Mondays. See what's going on in the Red Panda Academy. Follow him on Instagram. I know you answer people's questions all the time, Ian. We thank you for answering ours, but you're so generous with the knowledge. So thank you so much.